The screens turn red first, not slowly, not politely. All at once, Tokyo cracks open the signal. London follows. New York completes the collapse. Numbers don't just fall, they cascade, like glass breaking inside a silent skyscraper. Traders stop speaking in sentences. Only fragments survive. So, liquidity gone, get me out. Somewhere in Manhattan, a junior analyst watches his entire financial future erase itself in real time. He refreshes the screen again and again, as if repetition could negotiate with reality. It gets worse. Again. And again. But far from that noise, beyond the chaos of flashing terminals and collapsing portfolios, there is another space, a room without panic. No shouting, no running, no disbelief, just silence, and something far more unsettling. Calm. A glass of whiskey rotates slowly between fingers that do not tremble. Screens glow not red but green in specific, deliberate positions, one by one, while the world outside is breaking. This room is aligning. Someone finally speaks, not with emotion, with certainty. It's happening. A pause. Then, almost imperceptibly, they begin to smile, not because the world is ending, but because the system is doing exactly what they prepared for. Because here is the part nobody explains clearly. Markets are not built only to rise. They are built to move, and movement cuts both ways. You were taught that money is made by growth, by patience, by long-term belief. That is only half the system. The other half is hidden in plain sight. Because when everything falls, someone else is positioned to rise. And in that moment, nothing disappears. Not a single dollar. It simply moves hands. A crash is not destruction. It is transfer. Think of the market like a massive invisible chessboard stretching across the entire globe. Every piece still exists after the fall. Nothing is deleted. Nothing is erased. Only ownership changes. When prices fall, it is not because value evaporates. It is because sellers are forced to exit, and buyers step in at lower levels. Fear creates urgency. Urgency creates liquidity. Liquidity creates opportunity. And opportunity belongs to whoever is not forced to act. This is the illusion most people never see. They think they are witnessing loss, but they are actually witnessing redistribution. A global reset mechanism disguised as chaos. Not the kind of reset that ends the game, but the kind that reshuffles who holds the strongest positions. In calm markets, wealth expands slowly outward like ink spreading in water. But in crisis, the direction reverses. Fast, violent, concentrated. Those who must sell because of debt, panic, or structural pressure become involuntary participants in their own exit. And those who are liquid, who are patient, who are positioned correctly, become buyers of that forced exit, at a discount the system only offers during collapse. And that is where the real story begins. Because there are players who understand this architecture deeply. They are not loud. They do not predict markets in headlines. They position themselves in silence. One of the most famous examples is a man named Michael Burry, a doctor by training, a financial outsider by instinct, a figure who studied markets the way others study disease. In the mid-2000s, while the world was intoxicated with rising housing prices and the illusion of endless stability, Burry saw something else underneath. Not strength, fragility. A system built on low-quality loans were packaged and redistributed until risk became invisible on paper but explosive in reality. He did not just observe it, he bet against it. This is called short selling. The concept is simple and psychologically uncomfortable. You borrow something you do not own. You sell it at today's price. And later, if the price collapses, you buy it back cheaper. Return the borrowed asset. Keep the difference. Most people cannot process this emotionally because it flips the instinct of investing. It means you profit when something fails, when something breaks, when something collapses. But in 2008, when the system finally cracked open, this structure revealed its true nature. While banks failed, while credit froze, While entire economies stalled, certain positions did not collapse. They expanded, because they were built not for stability, but for instability. The world saw disaster. They saw mispricing, and mispricing is the language opportunity speaks during crisis. Billions moved quietly, not as celebration, but as consequence, because when systems break, they do not break evenly. They break where leverage is highest, where confidence is weakest, where assumptions were never tested, and that is where asymmetric positioning becomes everything. Because in finance, survival is not about being right often. It is about being structured correctly when reality shifts. And that brings us to the hidden tools of the system. Hedges, gold, asymmetric bets. A hedge is not what most people think. It is not protection. It is dual positioning. It is a structure designed so that if the world behaves normally, you survive. But if the world breaks, you benefit. Imagine owning a house and simultaneously holding insurance that pays you when the entire neighborhood burns down. Most people insure to recover. The elite insure to reposition. Then there is gold, not as jewelry, not as decoration, but as an escape mechanism. Gold exists outside the architecture of trust. It does not depend on governments. It does not rely on corporate earnings. It does not require financial stability. It simply exists, and when everything else becomes uncertain, it becomes a reference point, not because it rises, but because everything else falls in credibility. And finally, asymmetric bets. This is where wealth accelerates quietly. An asymmetric position is designed so that loss is limited, but gain is exponential. A small downside, a massive upside. Most people operate symmetrically, one risk for one reward. But systems at the highest level are not built that way. They are structured so that one correct outcome can outweigh dozens of small failures. This is why crisis creates disproportionate winners, because volatility expands the range of outcomes. And those who are positioned correctly inside that expansion do not just survive, they multiply. But there is something even more important underneath all of this: timing. Because none of this works without it. A crash is not just a price movement. It is a sequence. First denial, then hesitation, then forced reaction. By the time the average participant understands what is happening, the best opportunities have already been absorbed. The middle class often reacts late not because of ignorance but because of emotional alignment with the system. They are inside it. They depend on it. They trust it until the very moment it stops rewarding trust. And so they sell at the wrong time, not because they choose to, but because they must. Meanwhile, those positioned outside that pressure cycle do something almost uneventful. They wait, they observe, and then, when fear reaches its peak density, they buy, not aggressively, not emotionally, but structurally, piece by piece, layer by layer. Like shadows moving across a board after the opponent has already committed to an irreversible exchange. And this is why crashes feel unfair, because fairness assumes equal timing. But markets do not operate on fairness. They operate on positioning. And positioning is invisible until it is revealed by collapse. A crash is not the end of wealth. It is the redistribution of it, from those who react, to those who prepared, from those who are exposed, to those who are insulated, from those who panic, to those who design for panic. And when the dust settles, headlines will tell the same story they always do. Markets recovered, economy stabilized, confidence returns. But beneath that surface, ownership has shifted, quietly, precisely, irreversibly, because every crisis is not just an economic event. It is a transfer mechanism, a silent recalibration of control. And now you understand the part most people never see. Nothing in the system is truly lost. It is only reassigned. The only question that matters is not whether the next crash will happen. It always will. The question is simpler, and far more uncomfortable, when it arrives. Will you be part of the movement, or part of what gets moved? And in the architecture of markets, nothing ever disappears. It only changes ownership. Subscribe. stay ahead.